Everyone, this is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. Many of you are aware, you can see my PGA golf bag in the background of the other camera view, that my past life before the last 25 years trading options was as a golf pro. So I'd be remiss not to comment on the fact that how remarkable it is that Tiger Woods made the cut at the Masters this week. It's my favorite tournament. All right, getting to the markets. Fed Governor Brainard came out and said not only is the Federal Reserve going to start reducing their balance sheet, they're going to reduce it significantly and soon. How's that going to affect the markets? The yield curve, it's not inverted anymore. In fact, it steepened this week. Is that an all clear for the markets? Let's take a look at the charts. At the time of this recording, it is late on Friday evening, so the futures market is closed. Before we look at the charts, a reminder, last week we talked about this. We're going to be giving away 5 of our new AI-based time strategy subscriptions, alert service subscriptions sent out via text message and email once we hit the 30,000 subscriber mark. We're almost there. All you have to do to enter is to be a subscriber. So if you're not, hit that subscribe button, and underneath this video or last week's, post your favorite Chuck Norris one-liner. I gave you one of my favorites last week. I'll give you another one this week. This was kind of in honor of my mother, who's not doing well at this point in time, but one of her favorite games was Scrabble, and one of the Chuck Norris one-liners is, in Scrabble, if you spell Chuck Norris, you win forever. So let's have some fun with it, and let's get that 30,000 mark. We really appreciate it, and we'll give away 5 of those AI-based subscriptions. All you have to do is go to our website if you want to see more about it, ewotrader.com. Having AI infused into technical analysis is the wave of the future. We feel like we're on the cutting edge, and our performance has been absolutely unbelievable. All right, so taking a look at the chart of the market, if we look at the moving averages, you can see that we're still trading between the 10 and the 50-day moving averages, hitting the 50-day moving average on the low and the 10-day moving average on the high. So just consolidation over the last 3 trading days. We talked about that in Tuesday night's TradeFinder. And by the way, if you haven't signed up for TradeFinder, please do that as well. We do it every Tuesday night. It's free. We talk about the markets. We look for trade ideas, and we have a live Q&A session at the end. So every Tuesday night, you can live stream it, whatever. So please join us for that as well. But we talked about how here we were with this doji, and looking at trading between these moving averages. Which way are we going to break? We do have a qualified potential zigzag pattern to the upside here, but we've got to break above that 10-day moving average, and I think break that that A wave high to have an upside move. And on top of that, we have the news from Fed Chairman Brainard saying that not only are they going to reduce the balance sheet, you can expect a reduction in the balance sheet fast and soon. So you start withdrawing liquidity from the markets, that's going to make it very difficult for the markets to move higher. So that's kind of a show me thing as far as the potential for the upside zigzag. But for the downside, we got to break that 50-day moving average with the follow through as well. So right now we're kind of in between. This is a little bit of a wait and hold type of thing, wait and see, if you will. Hold your powder until we let the market break above that 10-day moving average with a follow through, or break below the 50-day with a follow through. I don't think we're going to have to wait much longer, but that's where we are in the markets. Looking at the interest rates, look at this 10-year. The rates are moving vertically to the upside. Now, I've mentioned before that the market could handle an environment of rising rates if it was a measured rise in rates, that the last thing the market wanted is a vertical move in rates to the upside. And I said, well, if the rates are moving to the upside, is that because money is moving out of the bond market? Because remember, the bond market works inversely. Prices and yields work in inverse proportion. So if rates are going up, money's coming out of the bond market. Where's it going? Is it going into the equities market? Well, so far it hasn't. But you have to leave that potential for an upside move there. But if the market is going to go to the downside and rates are going to go up, it's not a very positive scenario for the markets. And if we look at the 10-day moving average here, you can see we're a little bit overbought, if you will, on rates. In other words, rates need to come down and other money needs to go in to the bond market to satisfy this overbought condition. But if money is going into the bond market, it's likely coming out of the equities market, which means that's the scenario for the equities market breaking below the 50-day moving average. But rates moving vertically up is pretty significant. Now, if you listen to the financial networks, you were hearing that, wow, the yield curve is going steep. We just talked last week about the inversion in the yield curve, so I thought I'd bring the 210 yield curve back up, and there was the inversion right there, breaking below the zero line. So you can see it there, and a pretty significant inversion. Look at that V there. And then you move back up, and yes, there is a spread now. So if there's a spread, okay, great. That means the financials should be doing well, right? So let's take a look at the financials. We look at the XLF, and not so much. With the fact that the yield curve was going steep in the terms of some of those pundits on the financial network, I'm not one of them. Yes, the yield curve is not inverted anymore. Should be a good thing, but if that was really significant, financials should be roaring ahead. And when you look at the moving averages, all we did was satisfy an oversold condition in the XLF, and the financials came up on Friday and just hit the 10-day moving average on the high. So that's not the type of move that you would expect to see if this steepening of the yield curve was something that was a bit positive for the market to continue to move higher. And so now we want to look at the dollar. I mentioned this a while back, way back over here in the beginning of March. You can go back and look at the SPY recordings on our YouTube channel. And I mentioned back here that I felt like the dollar would hit 100 and then we would wait and see. Well, that happened today. I talked about it last night in our insiders meeting, which is what we do every Thursday night for our alert subscribers. It's for our alert subscribers only. It's a longer session. We do a lot of Q&A with our subscribers there. And I said that I thought that could happen today. It did. So look what happened. We hit above 100 on the dollar index and came back down and closed near the low of the day. So we opened, traded up there, and came back down. I think that's pretty normal. We're a little bit overbought in the dollar as well, but look, we're in a wave 3. So I think pretty significant move continued to the upside could be in the dollar. That's healthy. That, in my opinion, avoids something like what happened in 2008, where we have a global, worldwide financial crisis. So the fact that the dollar is staying strong, I think, gives us a little bit of hope for the markets, even though Fed governors like Brainard, et cetera, saying that the balance sheet is going to be reduced significantly and soon is not a positive for the markets moving forward. Thought we would take a look at gold as well, and you can see that we are in a symmetrical triangle in gold. So where are we going to go from here? I'm a big believer, regardless of what you look at with the Elliott wave pattern, that when you have one of these symmetrical patterns, you look at this wave 4 right at the 61.8% Fibonacci corrective level. You would think that's going to break to the upside. And if Elliott was here, he would say, yes, I think gold is going to break higher. All I'm saying is it's been my experience that when you have one of these Elliott wave triangles, you have to respect the potential to break either direction. Perhaps Elliott's view will be right, and we do break higher. I just think that looking at a triangle there on gold, or perhaps even silver, it's interesting that they're slightly different, because on silver it's more of a descending triangle pattern here, as you can see. And we put the Elliott wave pattern on. Now in silver, we're not in a 5-wave impulse pattern. We're in corrective mode, and that's where triangles normally show up. They can show up in impulse patterns, as you just saw with the GLD, but in silver we have a descending triangle pattern here. So basically what we're saying is with metals, they can break either way. Well, while we're talking about metals, we haven't talked about Dr. Copper in a couple of weeks, so let's take a look at that. If the economy is going to be okay, wow, copper should be screaming to the upside, right? No, not so much. Copper's not really moving significantly to the upside at all. And you take a look at this and you see, well, you could make a case that that's in a triangle as well. The wave 4 corrected 76% here. That's almost 78.6. It didn't quite get there, which would have disqualified an impulse pattern, but that's awfully close. So I think we just take a look at it here, but that's not a great triangle. I really like when the triangles touch the trend lines more often. So to me, this is more of a trading range, and copper is like, we have no idea what's going on in the economy. So we've got mixed signals. The dollar's looking good. That's something that again can stave off another great financial crisis part 2. We've had the inversion of the yield curve. So my opinion, 98% accuracy on a 210 yield curve inversion. We're going to see a recession a year or two down the road. But you know, could we move to the upside before then? We could. But copper should be moving to the upside if we're going to have some economic strength before then. And so far, at least, it's not. All right, last week we left out Bitcoin because there's only so many things that we can cover, and there's a lot of stuff I like to talk about, but we also want to respect your time and keep these recordings on a timely basis. So I left Bitcoin out, and boy, y'all got mad. Where's Bitcoin? So it's back. Here we are. And you can see we have this wave 4 level at 46%, so almost a 50% correction. But the most important things to look at with Bitcoin is we broke below 44,000, and everything with Bitcoin is in a $4,000 increment, right? 48,000 was a resistance level, and we couldn't get through that. So the next support was 40,000. Well, we've broken below that with a follow through, which means we're likely coming down to 40,000 on Bitcoin. If we can't hold there, then next is 36 and then 32 from there. At the time of this recording, we're a little bit lower than this. We're just under 42,000. We'll see how that, because remember it trades 24/7, so we're a little bit lower than this even at the time of the recording. But Bitcoin breaking 44,000 I think means that 40,000 is the next stop. And if you look at Bitcoin as kind of a risk on, risk off thing, that kind of plays into the more of a risk off type of a scenario. I've been talking about the Qs for quite a while, saying that I felt like the Qs are going to underperform. Even if the markets do move to the upside, I think the Qs will underperform the S&P 500 and the Dow. And here you can see we have this gap down. We haven't filled that gap, but look, we've broken below the 50-day moving average. Can we jump back up and fill that gap? We could, and that's at 360, which is now resistance. So moving back up to test 360 wouldn't surprise me, fill that gap, but we got to get above 360, and really now we need to get above that 61.8% fib level, my favorite fib level. So that's a pretty strong wave 4 there, looking like we could be heading down on the Qs with this follow through below the 50-day moving average to at least test these lows here at 320. And then you can see where the wave 5 is down here right around 300. I know a lot of you watch this because you ask about it all the time, and this isn't really what you're looking for. But in a period of rising interest rates, it's tougher on tech stocks, and I think the Qs are going to struggle and they're going to underperform. The only question in my mind is how soon do we come back and fill that gap? Is this going to be a breakaway gap? Are we going to head lower significantly, or do we bounce first, test that resistance at 360 before we head lower from there? I just don't think things look so significant for the Qs. Then we take a look at the Russell, and so much for that. All right, we had this one day above 210. If you've seen the recordings over the past several weeks, you know that in 2022, the Russell has just simply changed its trading range. For pretty much all of 2021, it was between 210 and 230, and now for 2022, we're in 190 to 210. So right there is a lot of touches, but I think that you can draw that line all the way down to 190. So perhaps we're heading back down there. We gap down there as well on the Russell. There's a gap to be filled. So could we get a bounce, a little bit of a bounce, at least early next week? We could. But when you have Fed governors coming out saying, you know, we're going to be reducing the balance sheet significantly and quickly, that's just not a positive for tech stocks or the small caps. So you look at tech stocks, Bitcoin, small caps, the Russell, there's nothing there that is more of a risk-on scenario that's given us much of a bullish outlook right now. That's just kind of where we are. And looking at Canada, we talked about this last night as well. So here's where we were with the Canadian market. We're in a wave 3, and I mentioned that I didn't really like the fact that we broke above that 40 level when we were kind of in an overbought scenario. You can see that we were separated from the 10-day moving average here, and usually when you break a major point of support and resistance, which we had there at 40, and you do that when you're already overbought, it likely doesn't hold. Most often it doesn't hold. The best case scenario would be to come down and test the 40 level and hold there and then head up towards that wave 5. Well, that looked like what was occurring. So for over a week, we did that. We tested that 40 level multiple times. We're staying above it, so that was a positive sign of the potential move up to the wave 5. But look where we are now on the Canadian market. We've broken below 40. We didn't really have much of a follow-through day yesterday. I don't think that counts. We're back up testing 40 now. We hit the 10-day moving average on the high. We hit 40 on the high. At least we're above the 50-day moving average. So if you're looking for something positive or constructive on the Canadian market, that's what you have. But also notice, where's the labeling on the 5-wave impulse pattern? It was there, and now it's gone. So it's disappeared, meaning that we're now in a corrective phase in the Canadian market, and it looks to me like we're forming a bit of an expanding triangle. Normally we look at contracting triangles. We have an entire portfolio devoted to these triangle patterns at ewotrader.com. Our volatility portfolio is devoted to these triangles because they break out. Well, with an expanding triangle, usually we see contracting ones, but expanding ones work the same way. So we're kind of in between there. Can we break back to the upside? Are we going to initiate a new impulse move? But I think it's noteworthy to say that it's concerning that that 5-wave impulse pattern, where it looked like we were in a wave 3, has gone away. It's been disqualified within the algorithm. And this software, Profit Source, if you're not familiar with it, it programs, you can find out more about it at hubb.com, by the way, hub.com, but it's programmed exactly to the mathematical algorithm that Ralph Nelson Elliott wrote. So I put a lot of faith in it. I wouldn't be using it if I didn't. Talking about all the commodities, and look at this, this may be the best chart in the entire market right now as far as trading. So here's the ETF, the DBC. Look at this symmetrical triangle. Now that's what a symmetrical triangle should look like. All those touches of the line, both the upper and the lower trend lines, so the lower highs and higher lows. Beautiful symmetrical triangle. Wave 4 at 47%. This is going to break out. Again, Elliott would lean towards the fact that it's going to break in the direction of the impulse pattern. My experience for nearly 25 years is the fact that, hey, when you look at this, it can break either direction, and you have to respect that. So a strangle on the DBC is not a bad looking trade. In fact, as I said, it might be the best trade in the market at this point in time. Commodities are going to break one way or the other, and it looks like it'll be a pretty significant break. Look at this. I mean, the DBC with the low on the mouth of the triangle around 24 and the high over 28, that's a significant move because we usually look for a 10% move. So if you look at the point at 26.5, you're only looking for, a 2.6 point move, and this looks like it can move 4 points. So we could easily get up and hit that wave 5 target, or come down and test this wave 4 here, maybe all the way down to 24 or lower, and even violate that wave 4. So that's something we're going to be watching. Where do commodities go over the next couple of weeks? And then last but not least, looking at the VIX, we have stayed down here. Some of our subscribers were asking, well, the fact that the VIX went below 20 and stayed there for a while, does that mean that, hey, the volatility is done in the market and we can move higher? I'm concerned about the fact that this move lower was vertical. You've heard me talk numerous times about the fact that I don't like vertical moves up in anything, even the VIX, because what goes vertically up often comes vertically back down. And I think that works in the opposite direction as well. That was a pretty vertical move down in the VIX. So could we see a move back to the upside? Look what we have here in today's trade. A doji. We're going to find out about that in the beginning of next week, in my opinion. A doji on the VIX. So do we break down below this? Do we start to come back down towards 15 or so? And do have that bounce in the market with what is a qualified zigzag pattern? Or does this doji mean indecision and you're going to see volatility rocket back to the upside? Regardless of how it plays out, it's going to be a really, really interesting start to next week. And we'll be back here to talk to you about it. So hope you have a wonderful weekend. Don't forget to hit that subscribe button. Post your favorite Chuck Norris one-liner. Let's get this above 30,000. Have some fun with it and give away 5 of our AI-based trade strategy alerts, our time strategy. So it's an income generating, it's perfect timing for this. You'll learn more about it if you go to our website, ewotrader.com. Have a great weekend, everybody.